Awesome. Well, appreciate it, Marty. I'd like to think they saved the best for last, and I think that's what you're getting here. Obviously not because of me. I imagine that there are some people in this room. I know some people on this panel for sure that know me, but for those that don't, my name's Dan Marcus. My career has been very interesting, depending on what you define as interesting. First as a founder, then as an attorney, primarily now as an attorney, and also periodically as a professor at NYU, which is what you see on the agenda here. But I will allow the more important people, i.e., the panelists, to introduce themselves, starting with the guy that's actually in the room, Chris Anci, and then we'll go around and then we will get into it.
Hi, everybody. It's Chris Anci. Have done quite a few of these panels for Marty, and thank him for having me again. 30 years financial services, buy side, sell side, all sides. Currently working with a family office based out of London, helping them with their investment portfolio and thesis, and then also operate a sell side banking shop where we are looking to play some Series A.
Okay, awesome. Gaurav.
Yeah, Gaurav Mehta. Did we lose?
Yeah, I think I think we lost the in-person people. So we're just kind of holding it down for everybody that's tuning in virtually.
Yeah, why don't we hold on one second?
I thought that was abrupt.
I'll text to Marty.
Kind of have to believe that they're aware that whatever's happening in the room got disconnected.
Yeah, I was on the wrong link. But
he said they're aware.
Oh, he says we can
You look
hear
good though.
fixing. There we go.
Yeah.
I may have broken the system.
Well, I think if they can see and hear us, I think for the benefit of being efficient, it does make sense to go through these introductions, and then hopefully by the time we get reconnected, we can get Chris back in the mix.
Okay, it looks like he says we
can see and hear you.
it. Okay.
Yeah, well, they'll be back in a minute. So Gaurav, why don't you go ahead just to keep this thing moving?
Yeah, absolutely. So Gaurav Mehta, I'm the founder and managing partner of Mehshah Capital. We're an independent sponsor focused on healthcare investing in New York City. We look for companies that are kind of in the 2-3-ish of EBITDA all the way north of 20. Our equity check sizes range anywhere from as low as 15 and up. My background, 20 years of experience, both on the buy side and sell side, similar to Chris. Was previously with Pinta Capital Partners, which was a family office here in New York City, focused on healthcare investing, and then spent 11 years doing investment banking, healthcare investment banking with Citibank, Barclays, and BMO. And then before that was on the buy side with several other shops. That's me. Thank you.
Awesome. Serge and then Alex.
Thank you, Dan. Thanks for having me. Serge Jonnaert, Managing Director for The Merger Company, an M&A advisory based in Southern California, focused mostly on the lower middle market in tech, medical devices, as well as in terms of geographies, US, Canada, Europe, and the Middle East, where I also spend a good amount of time. So.
We just got a message from Marty that we couldn't hear you, Serge, but I think everybody here that's online could. I heard everything you said. Yeah. No, you're good. You're good. You're good.
Okay.
I'm letting that know I'm saying it for the people that are in the room to try and triage whatever audio visual malfunctions are happening. Alex, go ahead.
Thanks everyone and Marty for hosting this. The technical difficulties notwithstanding. By background, I'm a recovering chemical engineer, and I started in the investment business in 2012 with a single family office, spun out in 2017, run Limitless Ventures, which is backed by about 20 LPs right now, focused on fixing mental health, specifically things like depression and alcoholism and addiction. And so we do deals on a deal by deal basis as an independent sponsor. Thanks.
I don't know if this is gonna be a joke that lands, but you went from being a recovering chemical engineer to helping people that are recovering from chemicals.
That's right. That's a good one.
Gotcha. I don't know if that's an
I'll
uncouth
give you royalties on
observation.
that one.
Hey, you can use that. That one's all you. That's my gift to you. So Chris, you can see us, you can hear us, you're good. You give me a nod if you can hear us. You're on the room is on mute. The room is on mute. But I'm gathering that you can see and hear us. I'm gonna start with you, Serge, and I want to kick it off this way. I'm kind of wondering, just in this space, and we can veer it into private equity broadly, but we can, I'd like to limit to obviously the topic here, independent sponsors and search funds. What kind of deals are you seeing actually getting done in this space, and who's primarily investing in them? Or for you, maybe it's the answer involves what's happening upstream, if anything.
Yeah, I mean, it's definitely challenged right now. I would say the bar has been raised, and most of the both financials and strategics are only looking at companies that already, I would say, have some operational maturity, $10 to $15 million in revenue, $3 to $5 million in EBITDA. So that kind of narrows the field a little bit. We're busy. We're doing work both in tech as well as in medtech. I mean, I've got 3 medtech companies in market, and there is good, solid interest. But I've definitely become a whole lot more selective in the types of mandates that we take on. So
that's actually a pretty good segue, and I do want to let other people answer the original question. But we have 3 people here that are in either healthcare, in the medical space, and or health tech. So, I guess I'll go to you, Gaurav, and then you, Alex. What is it about just like the healthcare space, health tech, that for you individually, and I guess investors more broadly, is facilitating getting more deals done, or is conducive for getting more deals done?
Yeah, I mean, I think for me personally, was a bet I made a long time ago, and it was kind of a two-faceted decision process early in my career, which was number one, I'm kind of an altruistic guy, so I actually want to help people and help society. And about 15 years ago, when I first got into healthcare, I saw that healthcare had a lot of problems, and I wanted to be part of the solution. And I had a good background in training in finance and knew that, hey, finance has a lot of influence on the direction that industries go. And so I knew I wanted to be part of that, and sort of bet my career on that personally. That all said, I think healthcare has gotten to be big from a deal perspective because of, I think, the obvious, which is you have a huge baby boomer population that is aging, and it has a need for healthcare services, and those needs are increasing as those cohorts age out or age up. And so I think what you're seeing in healthcare, and all the innovation that's going on right now, and as a result of that, all the deals, is driven by the fact that there's a lot of demand. There's not a lot of clinician supply. So there's a lot of problems that are getting exacerbated because of the supply and demand imbalance. And so what you're seeing are innovative models coming to market that are trying to solve what was historically kind of many healthcare institutions are run kind of like nonprofits. They don't really care about, earnings. And you've seen over the last 15 years a big migration towards innovation and becoming, sort of more buckled down from a fiscal standpoint. And so deal activity as a result has dramatically increased over that same period.
So you mentioned you got into it from an altruistic perspective. Are you operating a nonprofit model? Are you donating all the profits, or are you still doing the capitalism thing?
So the way we think about investing is we look for models, like business models, that actually improve the quality of care at a reduced cost. And so if they're disrupting and they're making actual impact, then we invest in them. We are not impact investors. We are still capitalists, and we have our fiduciary obligations, obviously, to our investors. But I think when you're aligned with doing what's right, you typically make money. What a concept. And so I think that's kind of how we've approached it. And, I think our track record reflects that.
Okay, fair enough. I'm only asking because it feels like in recent days capitalism has become more passe, but hopefully it's still alive in this room at least. Alex, I'll ask you the same question, but you can answer it from your specific lens, which is basically like why why healthcare is a space where these kinds of deals or this kinds of capital is flowing. And you can, frame that from your own personal investment thesis as well.
Thanks, Dan. I agree that healthcare, is perfectly inelastic, right? Like most people who I meet, want to live happier, healthier, longer lives. And like whatever they're recovering from, like you don't even need, it doesn't need to really get that bad. Like, hey, I got my knee redone. My dad, he wants to walk and like go skiing, and at 88 he's still out there. So so that's a great demand curve for us to get behind from an investment thesis, and by helping people do those things regardless of whether it's mental health or not, right? That's an investable thesis. Doing well by and doing good while making money, that's the dream. So that's kind of how we think about it too. I think our track record represents the same, and I think that the independent sponsor model is kind of catching wind. If you look at the data, I did a little homework here beforehand. Independent sponsors have gone roughly from 300 people in 2015, 16, 17 to roughly 11 or 1400, depending on which source you cite, today. And capital has gone from $2 billion to 25 in deployment. And like, why is that? And I think most family office, like our anchor family office, the Ross family, really doesn't want to pay 6 layers of fees with the RIA, the investment banker, the guy, the fund of funds, the deal guy, and then the deal. It's just annoying. That's 5, just in case someone wanted to check me. And so I think independent sponsors give that home run to that opportunity, which naturally creates alpha by removing financial friction. And also, as a result of being thematically aligned with the mission of whatever that family is interested in doing, who I think tend to be the primary sponsors of these sorts of deals from a capital side, is it feels good. You feel good by helping people. So you see someone walk again, you see someone recover from substance use disorder, it brightens up your day. So I think to answer your question, those are the wins that are blowing these sales.
Well, that's what we're here to do, is brighten up people's days. So, Chris, considering you're the one in the room, I'm hoping that you can brighten up everybody's day in the room. But I want to kick a question to you, which is this. So Alex gave me another good segue, which is just about independent sponsors generally and the popularity of it. You represented and worked with family offices. You work with one now. What's the attractiveness of an independent sponsor versus getting involved with having to invest in a fund or the proposition of a fund? What do you advise? What's your preference, and why is it becoming more attractive?
I couldn't really get the question, but I'll just, if you're asking, are family offices like not doing funds? Is it like there's an overwhelming trend of a lot of people not doing funds now. They want the direct investment, which is also led to the independent sponsor thing, because you've got people that are gated for 10 years. And then there's continuation funds where everyone's now gated for another 5 years with somewhat lower fees. I think somebody mentioned yesterday that some sophisticated investors, family office, 38% of their portfolios jammed up in privates. We all know that Yale and Harvard and all those guys are net sellers because they actually had to go to the bond market to raise cash because they have no liquidity. So everybody wants to go direct, and they want to be able to, and as Alex said, people just want to look, the buy side has control of the card table at this particular segment. They're seeing 10,000 deals a day. I mean, I'm seeing a boatload of deals. And you can't see them all. You can't go through them all, but they have the right to be picky and choosy, and they want to go direct and work with companies that they specifically want to get involved in, and strategically. you're not like, I think 5 years ago, people were jumping in a lot of boats. I mean, zero interest rates can, could be a lot of malinvestment. Candidly, I'm on some Zoom right now on this exact topic. There's a handful of people stuck in a bunch of SPVs for 7 years and they're trying to get out. And the CEO is saying you can't. So going back to the earlier point about healthcare, and I had somebody recently just say to me, it's, we don't invest in health tech, we invest in tech health. And I think it's an interesting, thing for everybody to talk about from where people are leaning, because the family office that I'm with right now does do a fair amount in the healthcare space. Like the baby boom generation has been the chicken and the snake since they all needed homes, after World War II. And then they needed homes, then they needed schools, then they needed colleges, then they needed jobs, and in the 80s they needed, party drugs. But like, so we could follow these guys all the way through the entire segment. Now they're all playing pickleball, and they think they're still in the 80s doing whatever they were doing, and they're blowing out their knees and they're blowing out their elbows and stuff like that. The other thing is at the advent of the internet, we realized that the internet was very good for two things, specifically stock trading and some other kind of visual sort of entertainment. What you're seeing now is the evolution of tech is now finally, after many years of promises, like reaching healthcare. I mean, how many times do you see people with the diabetes thing on their arm, and all of these tracking stuff, and the millennials we're catching some data. I mean, the millennials, their data crazy. I mean, they're watching their steps, they're watching their this. They go out for a night, they wake up in the morning, they see how it affected their sleep, and it's changing their behavior. So I think there's a golden age for health investment coming forward. And to come back to the original question, I think direct health investment actually into the companies.
Speaking as a millennial myself, I don't think it's that we're data obsessed as much as we've got like the dopamine part, like centers of our brains that have been rewarded just by looking at our screens and seeing if we have an email or a text message that long. So like if you look at your sleep score or whatever it might be on your Whoop, I think that's all part of it. So I think you might be giving my generation too much credit. But I was picking up on some of the body language here. Alex, you were nodding along pretty vigorously. I don't know if you had anything to add or to comment on what Chris just said, but I'd give you the opportunity, considering it seemed like you were at least getting a kick out of his vague live entertainment references or other forms of entertainment references.
Well, he's great at stand up. I agree. That there everything I would double click on. I don't want to be redundant. So what I think the younger generation listen, I was born in '88, so I'm part of that younger generation, and I do wake up, look at my sleep score, and behave differently, and simultaneous. So that wave is happening on a macro level, while simultaneously there's this giant wealth transformation, right, from one generation to the next, while simultaneously there's still all of the silver wave healthcare opportunities, and that just creates a wonderful investment landscape to help investors directly invest into these direct deals. The thing I'm interested about is what happens to the private market independent sponsor lens. Like, hey, I'm stuck in an SPV for 7 years. Where does that go? If it doesn't go, does it trade away to another buyer, just like the typical private equity market evolved into, where private equity fund X is buying another private equity fund? Or is there a different type of liquidity, or does AI and robotics come in and just end up making these illiquid assets cash flow to a point where I'm willing to hold and get that dividend indefinitely, where I'm not getting 5 or 7%, and we're modeling some things out to like 10 or 15. We're like, wow, I'm a long-term investor. I've got a 30-year view. I don't need, or nor do my LPs base need, an exit that is a big event. I could just take this dividend forever. And by the way, I pay less to Uncle Sam. So, what I'm interested most is where do the liquidity lockups go? There's no way I want to get back into anything that's related to any regulatory ILPA standard, right? None of my LPs want that. So, I think that's just, I think, the most interesting question for independent sponsors.
I think you're doing my job for me, and I'll leave that question that you asked and kick it to the M&A guy, Serge, and say, like, where does that liquidity go?
No, I think, I mean, just to bring it back again to the independent sponsor or search fund, Norm made a comment earlier that I thought is also befitting here, right? You need to have people that are passionate about something, that have some domain expertise, and can actually carry an idea. Because, I mean, one of the things that I've seen, especially now in the last couple of years, with a lot of investment in earlier stage tech companies, that everybody's gravitating towards kind of the coolest, nicest shining object. And I always spend a lot of time at CES as well, where you see a lot of these companies come and go. But you really have to have something that you can extend further and truly build a company around, and not something that's just a cool idea. And there's so many of them out there, and I mean, most of those don't make it past year two. So.
Gaurav, I'll kick a question to you, which is, what Serge alluded to is like you need someone who knows what they're doing in the operator seat. And so how do you vet operators, and where do you find operators in an independent sponsor kind of model like yours?
Yeah, well, because we're like industry focused, obviously have been doing healthcare for 20 plus years. You build a big network of relationships and operators that can make sense. I mean, the way we think about it is whenever we identify a particular area of interest to us, we find an operating partner to go and tackle the industry with us. And with that operating partner, they typically have a lot of relationships that they can bring other operators into a company to help grow it and supplement the existing team if the founder's staying on. So that's kind of how we think about how to find and work with operators.
So I know it's something that we talked about, but when we did our little prep call, which is, a little veering away from independent sponsors, which I know we've talked about for the good portion of this early conversation, and talk about search funds specifically. And we talked about, and I think Gaurav, you're the one who mentioned this, that there's like two archetypes of who a search fund, call it like founder operator is. And I'll let you explain that because you probably explain it better than me. And then we'll talk about some more of like the gaps in between, but why don't you go ahead and do that?
Yeah, look, I think on the search fund side, you get kind of two buckets of people who are actively looking to run a search fund. So just taking a step back, what a search fund is where it's somebody who wants to go and acquire a company, go find a company, then acquire it and run it as the operator. And it's been popular for a decade plus, so it's picked up a lot of steam recently because you have so many baby boomer generation companies that are kind of like orphaned, and they need a successor, and there is no successor because the kids don't want to actually take over the business. And so a lot of what's happening right now that you see in the market is an enormous number of folks coming out of business school are no longer interested in going and working for a big corporation. They'd rather raise a search fund, which is a fund that you raise some money to fund a search and then go acquire a company and operate it. And that's one group of folks that are actively out there searching. And that's the traditional search fund model. When most people think about it, that's how they think about it. There's another group that's actually quite large and people don't think about it as much, which is professionals in the industry who maybe have grown tired of mid-level or their senior level, and they've grown tired of working for the man, and they decide they want to go off and rather than start a company from scratch and try to grow it, go buy a business as a starting point, whether it be a platform or something that can be transformed into a platform, and then subsequently grow it and run it. And last comment I'll make across kind of the overall search fund market is actually, if you look at the statistics of like return on investment, search funds have outperformed private equity as a sort of traditional private equity, and have outperformed, obviously all the other kind of areas where you can get an ROI, like the public companies. And so it's actually a great kind of sector to be investing in. And there's a lot of information on those ROIs published by Stanford University, where are kind of where starting point around this might be 20 plus years ago when this whole concept first started.
Never heard of them. Chris, from like, so from like a search fund perspective, why do you, and I guess, I mean, Gaurav mentioned it, but I'm giving you the family office perspective on this. Why do you think it is that the ROIs have been higher? Is it because the structure enables there to be more skin in the game than your typical 2 and 20 fund manager? Like they're hungrier? Why do you think that might be?
I think that because you have an established business, right? I think that we stopped doing pre-revenue companies years ago because the ever famous pivot phone call from the founder would come in, and that was always challenging. They needed more money because the shampoo that they were making was now going to become a Bitcoin miner. So it was a little bit of a change of business plan. I think when you're seeing this trend of people going out wanting to buy established businesses with established EBITDA, they'll pay a premium because it's already de-risked in the sense that there's a market. What they're bringing is their ability to take maybe some tired management, whether it's the second or third generation in the company, and they believe that some fresh energy could then bring some growth, and then they can institute some stuff. And I think, like we mentioned in our pre-call on this particular subject, a lot of times when you're looking at family-run businesses, there's a lot of fluff being run through the company. And I think that if you can get like 3 generations of people's cars and beach houses and a bunch of other stuff, from flowing through the company, you can get a couple of extra points in EBITDA. So I think that's it. Look, I've got a very close friend of mine, and he's been schlepping at Raymond James for the last 9 years, and he finally got out. And the first thing he did was he found some guy with $150 million RIA, pretty sticky base. And, he paid the guy some upfront money. He's going to do a 2-year earnout or 3-year earnout with the guy hand in hand. And he's like, look, it's got revenue. I don't have to chase. I'm not going from 0 to 150. I'm starting with 150. He's been in the business for 35 years. He thinks he can get it up to whatever he can get to. So I think the trend there is people want the momentum. That it's de-risked.
I want to ask a question here. So can you guys talk about the raising capital aspect of the businesses that you're in? Like, do you have a, bullpen of investors that you work with primarily, or is every investment that you look at, you have to find new investors for? Can you talk about what that looks like for each one of you?
Since I'm here, I'll jump in.
And the camera's over there.
And hi. Getting my profile. Hopefully it's my good side for the video. What I typically do is I tell everybody that we're looking to raise capital for, that we will never spray the street with your deal. We will go to the strategics that we have that are a fit. 5 years ago, people were jumping in the boat for any deal that you put in front of them. Now you have to go to people that have, almost like search funds to a point, you have to go to people that have kind of an expertise. They're in the space. Either they have an affinity for what you're selling. But if you're going to call somebody you're going to call family offices or high net worth individuals and give them a real esoteric healthcare deal, it's a long shot. You got to do. So Marty, your point, what we do is we really look for people that we know that would be strategically beneficial to the company, and we offer it to them.
I'll let anybody else take that question. I mean, Gaurav, you're the one that's off mute, so I'll go to you.
For us, we try to build bespoke LP bases for our investments, and so we really look for strategic capital. And I think when you build a strategic LP base of investors, they have skin in the game, and they're going to be wanting to help the company grow. And so the way we go to market with our investments is exactly that. And it's how, I think a lot of founders go with us because of it. And, we put where our money where our mouth is. We deliver on that. So that's kind of our approach with fundraising.
Alex or Serge?
Well, put it this way. I know Gaurav mentioned the Stanford study. To be honest, I shy away as much as I can from, I would say, the junior executive MBA search funds and independent sponsors, because there are a lot of work up front, because they want to do all the due diligence before you get a deal proposal. Then ultimately, if their sponsors say no, then you invested a lot of time and effort in it. That being said, I do feel that there is kind of a whole segment of the market, and Gaurav also mentioned that, of kind of former executives that are not even familiar with kind of that independent sponsor search model, and are always looking for opportunities, but aren't really, don't even understand the mechanics of how that ultimately works. And I think that's where truly there's an opportunity, kind of as a matchmaker for people that have worked for companies 20, 30 years and maybe want to have one more kick in the can and operate a company. And can at least do so with solid credentials, haven't had experience in an industry, haven't had an operating role, etc. So that's, I think, where for those guys to kind of figuring out how to go and approach family offices and private equities that sometimes underwrite these things. That's where I think there's a huge gap in the market.
Yeah, I think you're right, Serge. And for me, the question is great, Marty. Thank you for bringing it up. Every deal is like a micro fund, right? Like every deal has its own capital base. And you're right, Serge. It's a pain in the ass, and that's why I think it's a very relational business, right? My network probably grows by like one or two people, real meaningful people every year, because one of them has a conversation with a friend on the golf course, and they pass them on to me. And I like to say 6 meetings in 9 months, because it takes 9 months and 6 meetings to develop trust. And what is this capital really a function of? It's a function of trust. Do I believe that you will take care of my money the same way I'm going to take care of my post-tax dollars, right? That I've worked hard to make and pay taxes on. And so that can get built in two weeks. It's rare. And so I think serving up people families deals that fit the themes that they're interested in, that they're focused on. Like, I hate it when an entrepreneur comes to me and it says, fund my Bitcoin deal. I'm not funding any Bitcoin deal. I have a mental health focus, right? I'm not doing Bitcoin, guys. And my LPs and the broader network, I think they're looking for that same level of focus, right? Give me the things that I'm looking for, and don't talk to me about these random other things. So I think being thematically aligned, focused, niche, bespoke, those are all insensitive to other person's time. It's like being a driver in New York, right? When the light turns green, you go as quickly as possible.
I think the moral of the story, what you just said, Alex, is that if you need to raise capital, you need to either learn how to play golf or play more golf. That's basically what I heard. So Chris, I want to go back to this because I know we've talked about this, and for those that have heard me have this discussion before, I apologize. I just find it personally fascinating, and I think it makes a lot of sense because of the fact that we've talked about healthcare being a big sector for independent sponsors and search funds. And the question is this: is a moral question: is that are there sectors, are there areas like healthcare where the injection of private equity dollars will actually it might increase an ROI of a business, but will hurt the ultimate, I guess, externalities of whatever that business is. I think healthcare is a good example of that.
Well, and we've had many a joke about the, veterinarian urgent care on every corner in Manhattan, which is a very unique private equity sort of idea.
Scam.
I had
That's
I had
what
a
the word
dog
you
for
meant to use.
17 years. We took him to the vet a couple of times. I don't know how much people are taking animals to the vets. I do think that I've been a little bit academically kind of curious as to why some capital's flowing to where it's flowing. We all get the data center trade and the power trade. We understand what's going on there. But some of the trends inside private equity, like if I see one more HVAC roll up deal, or it seems like they're very downstream, and I can't kind of figure it out. And I don't know if it's because everything else is picked over or everything else is too expensive, but it seems like everybody's searching high and low for like any form of consistent cash flow that they can find. And it doesn't really matter. So I do think, and you've brought it up once or twice about the moral component in some businesses where, I mean, we can go back on this kind of stuff. There's a moral component to sort of healthcare too. You want to sell as much shampoo to people as you can. Starbucks wants to sell as much coffee as they can. Do you really want to sell as much dog care as you can and bankrupt people, like because you got to hit the metrics that you promised everybody. So I do think it's a little bit of a curious trend in terms of, some of the areas that capital is flowing. So we'll see how it all works out if they all go back to being banks or cell phone stores. But
Yeah, it's kind of like being in one of those zombie apocalypse movies. Like, especially, I'm sure there's a lot of homeowners in this audience. You try to bring someone to look at, like you mentioned, HVAC or a plumber or someone to look at your foundation, etc. And then you do a quick Google search and you end up calling them, and there's this central call center that says, "Oh, you called so and so, a groundworks company." And you do a quick Google and you found out that it's a KKR roll up, and you're like, God damn it, you got bit by the zombie too. Who's not as like, who can I trust? Right, as far as there being the incentive to actually give you a good service. I guess to frame this question more specifically, Alex, do you think there's a world where profit and care and healthcare can be aligned in this kind of context? I assume the answer is probably yes, but I do wonder about those kinds of things.
Yeah, I mean, every payer everywhere is talking about value-based healthcare and, mostly hand waving right now. But I think eventually it gets to a point where profits become tied to quality. And that's kind of really important because it's in alignment with the doctor's oaths, the Hippocratic Oath, and, the first job is do no harm. And and I think ultimately that's probably where data and alpha will merge. That's going to take some time because they hold the keys to the kingdom in everyone's life with reimbursement codes here in America. In other countries, and that's different. I focus domestically to the U.S. And I think that's a point in the future, not a point today. But as the data sets grow, and I think AI is going to love the data set of behavioral health as more becomes available. I can't wait for my AI assistant to say, you're going to get 5 more years of life because you decided to go to bed at 10:30 p.m. instead of 12:30 p.m. Thanks so much. And you're going to tell me that like New York Life Insurance Company isn't going to lower my premium on that life insurance product because I decided to do that? Hell yeah.
Well, what about when it's the opposite? Oh yeah, you eat like shit, and New York Life Insurance knows about it. So
Yeah,
therefore
it cuts both ways.
your premiums are going to be exorbitant.
That's called obesity in America, like and Coca-Cola. Thank you very much. I think we're already there, and how do you get people to behave differently? You give them the right incentive at scale. That's always been the answer. It always will be the answer. and economics will in some way, shape, or form are always tied to it.
Okay, so the invisible hand. All right, we got it. In some sense. So what other sectors, like, again, we've Chris, you alluded to it, like the HVAC roll-ups have been beat to death. We've obviously talked ad nauseum about healthcare in this conversation. What other sectors are you seeing in terms of independent sponsor deals, or just private equity dollars writ large that are where they're flowing? Serge, I just saw you come off mute, so I imagine you got an answer to this question.
Well, I am looking. I mean, needless to say, it's funny. Everybody said, "Well, looking high and low." I mean, we're doing the same thing, and are definitely looking in specific verticals, right? Verticals, industries that haven't seen a lot of technology adoption yet, and where you can kind of bring in a tech company that has a better mousetrap. And kind of see if you can kind of piggyback that with a roll up in a particular industry. I forgot who mentioned it yesterday. That I think it was transportation. There's definitely a lot of sectors still where a lot of businesses are run on Excel spreadsheets and on paper. So those are the pockets where you're looking at marrying tech innovation with traditional brick and mortar industries, and they're out there. You just need to dig a little bit, and that again, I mean, that's also where some of these independent sponsors come into play as well, because you will have people that are free agents out and about, have worked in an industry like that for 20, 30 years and are looking for something else to do. So
Do you have any, for instances, specifically about those kind of industries that you described more broadly?
I'm doing some work in oil and gas. I'm doing some work in restaurant tech right now. So yeah, I mean, frankly, it's been more opportunistic than anything else. Now, of course, just the last couple of days, I've had a couple of conversations with end of life services. I mean, one of those things that nobody wants to think about, right? But that is also a whole booming business. Kind of, it's not only about like companies like Trust and Will, for example, that are providing a better scale solution for people to put trusts and wills in place, but also to start thinking about, hey, I'm really sick. I really have to start thinking of the fact that I've got maybe 6 to 8 months left. What are some of the things that I need to do? And all the tech that surrounds that. So an interesting world, but again, that's just one of those narrowly focused verticals. Like Alex, I've done some work in addiction management at scale. So that was also very interesting engagement.
I've done some work in addiction management too, largely with my football gambling habits. Chris, you always have something interesting going on. Same question to you.
Dan, just so you know, you got about 10 minutes.
I've got 10 minutes. Okay, that's probably 5 more than I need. Chris, I'll kick this to you all because you always got something interesting. What other sectors are you seeing? Because, like, again, we know the same old, same old. I don't know how well I'm coming through the audio because of the way that you're standing up. I'm just asking you what other sectors outside of like the same old HVAC roll-ups that you're seeing in terms of independent sponsors, private equity, et cetera.
You're asking like roll-ups?
Not roll-ups, just other sectors that where you're seeing deals like independent sponsors, search funds, directs.
I'm working. I'm actually working with one right now, which is it's a very, very interesting deal. It's about 5 different companies varying in size, and it's a supplement business for men and primarily women. And it's got some menopause related companies in there. It's telehealth, and the numbers blow off. When you put them all together, they blow off, and that is an independent sponsor deal. The person putting it together is all she went and found all the different puzzle pieces, and it really works out well because when you put the 5 together, they all become vertically integrated because somebody's got each one of them have a different piece of the plumbing, So then they could all do a piece and it all goes down the one funnel. So I think that that's an interesting business model. That's all telehealth, all online, no bricks and mortar or nothing. So it like the EBITDA it's a fantastic model. I think if, there's RIAs, like I mentioned, my friend, I mean, the RIA roll up is crazy. I got guys in Rochester, they got a $300 million RIA. It's been in the family for 56 years. They take care of everybody, this one subsection of upstate New York. They get 2 phone calls a week from private equity wanting to roll them up into something. So I think, definitely in the RIA space, there's a lot of roll-ups. So I don't think it's industry specific. Again, I think it's this need for consistent cash flow wherever people can find it, because Wall Street puts a value on annuity-based businesses. If you got a transaction-based business, good luck. If you got an annuity-based business with and your ARR is where it is, I think that you can end up getting some value down the chain, and I think that's what everybody's hoping for.
So what's the common characteristic where all these businesses have seemed to either plateaued or they're not maximizing their potential that you guys have all seen? And what's generally the way that gets either remedied or fixed or augmented in terms of just realizing the full potential of these businesses? And Chris, you got the mic. If you can hear me, I'll start with you first and go around the room here.
I think that founders, in most businesses, founders can get to a certain level of achievement. But if you're in the CPG space and you're a whiskey, or like I've mentioned, a sunscreen, obviously I'm involved in one. Like if you get to, God bless, you got on shelves, you're doing your D2C, you've gotten to where you are not getting national distribution unless you partner up, unless you go somewhere. It's going to be really hard pressed. So there seems to be some businesses that get ripe for a roll up, because they just reach a certain point where they can't grow anymore on their own without a balance sheet partner, and in order to get there. And then on other businesses, I think it could just be pressure. I think, there was this guy, he had like a couple of eye doctor, or he was an ophthalmologist, and he got rolled up into a bigger thing. And I mean, he's thinking he's going to buy it back from them in a couple of years at a discount, and just carry the float for a couple of years. But I think sometimes it's pressure. I think maybe life gets in the way and they just need a liquidity event.
Gaurav, what are you seeing as far as, in your sectors that you look at, why these businesses either plateaued or not reached their full potentials, and how do you usually fix that?
Yeah, that's a good question. I mean, it's always a kind of a bespoke situation, right? So you have to understand what the underlying issues are in the business. Why is it not going? Or do we have a sales team that's buying revenue and not caring about what the contribution margin is? Do they have the right sales incentives in place to make sure that they're actually generating profitable business? Like it just varies, company by company. So I would say, like, there's no easy like, universal answer I can give you on something like that.
What about a good, for instance? What about a good war story?
Yeah, I would say a good war story would be one of our portfolio companies. Recently, the founder had he's just been spending money to like crazy on marketing to try to acquire customers, but rather than going direct to consumer, which is it's a D2C business, he's been focused on getting the nurse channel to try to do it for him. And I think it was an experiment that didn't go very well. And so it's really about, sort of, recognizing what happened. They've corrected course since, and have actually, kind of got the business back on track. And so it's just really about, again, identifying what the issue is and solving for it.
He was trying to get nurses to sell his product for him.
Yeah,
Hey, Dan, I have a question.
It's a disruptive business where they do med spa treatments in the home. So there was just some issues there that had to get resolved.
Interesting. Yeah. If anybody's there, Marty, I heard your question.
Yeah, so I have a question, and hopefully it'll be the last question of the day. So can you guys, I know you guys talked about, the boomer retirements and things like that, but can you talk about three trends, which I think are pretty important, right? So the first one is deglobalization and how that impacts private equity, number one. Number two, Trump has pretty much stated that he's going to be inflationary, right? This is why they didn't cut the budget too much, because they said if we cut too much government spending, it's going to throw us into recession. Nobody wants to go into recession. So to me, that means we're going to be inflationary. So that's number two. And then the third thing is this thing with stable coins. I don't know if you've been following the stable coin thing. Amazon announced that they're going to be putting on a stable coin. Walmart announced they're going to be putting on a stable coin. It's all to avoid credit card charges, right? The 3% extra that you pay on your credit card bill for charging something through when you buy something at the store, right? So any thoughts on the impact on, on private equity and opportunities for vendors potentially? What do you think? Does any of that impact your type of clientele? Inflationary, deglobalization, and stable coins.
Stablecoin sounds like a financial tower of Babel at some point, right? Like if everyone's carrying, Walmart stablecoin versus this stablecoin. Anyway, you didn't ask my opinion. I'll leave it to these guys.
Yeah, that's a loaded question. I mean, I would say, healthcare is a highly localized business, so deglobalization won't really impact that. Unless you're talking about like pharmaceuticals and deglobalization of manufacturing facilities. But on the healthcare services side, digital health, I don't think that has an impact. Don't have an answer for stablecoin. And what was the third one? Sorry, Marty.
Inflation, deglobalization, and stable coins.
Yeah, so from an inflation standpoint, obviously inflation causes wage inflation. When you have wage inflation, particularly in healthcare, where there's government reimbursement risk, what happens is, if wage inflation is growing faster than when the government increases the reimbursement rate, you get squeezed margins. So that's been an issue for the last several years, and it probably will continue to be.
Well, deglobalization, healthcare,
financial models, I would be saying we got to raise prices to survive, right? I mean, whatever financial models you had, just increased the pricing by 3% more or 5% more annually.
and deglobalization in healthcare. If China stopped providing us with antibiotics, we'd be kind of fucked. Go ahead, Serge.
Yeah, I was going to add the whole deglobalization. That's definitely an area where I see, at least on the M&A side, a lot of opportunity. So I am in discussions with both companies in Europe, here in the US, to really that may not have had a footprint on another continent, that are definitely right now considering that and looking at acquisitions to be able to do that. So
I just want to point out, Serge, how right you are, which is that it never happened before. We're being contacted by global healthcare, pharmaceutical companies, et cetera, who are in Europe or Asia, saying they need to break into the United States, but they're looking for funding to build a subsidiary here in the USA, or American corporation using their technology, which will be licensed, et cetera. So that we're seeing, that never happened before, but we're seeing that as a result of deglobalization. So
I think on the inflation front, when Doge, as we all know, there's probably about $1 trillion in theft and graft, but Bethesda, Maryland real estate depends on that. So I think that's why Elon kind of left, because they tapped on the brakes. I mean, in a fractional banking system, if they're stealing $1 trillion, it's probably $8 trillion in GDP. So that would be a heck of a recession. So I think everybody bit the bullet and said, all right, you know what, we got to pay all these NGO CEOs $500-600 grand a year for no reason, but it'll hurt the economy. The globalization thing is interesting. I read an article about a company who says they build everything. They weren't building steel. They were like, we got to build steel. They went to Tennessee. They found a place. Tennessee was great. They built the plant. They got tax incentive, the whole 9 yards. They realized that all of the machinery was either German or Italian. And now in a Memphis bar, it's packed full of a bunch of guys speaking German, because they had to bring the German guys over in order to run the machines to make the steel, because we didn't have the engineers here. So I think this I think it's the smart thing to do because we learned during COVID that we don't even make a Tylenol in this country. So I do think that it's important that we start making stuff here again, but that's going to be a really interesting Gordian knot to untangle. In terms of stable coins, I mean, who really knows? I mean, look, we got a tariff argument, and which is in late 1800s kind of, mercantilist economy. Banks issued their own script, if I remember correctly, in that same era. So now if you're going to have Walmart and everybody and their brother offering their own stable coins or whatever, it kind of gets a little bit interesting to me. Maybe what's old is new in terms of everybody. I mean, Pullman Railroad Car Company, right? I mean,
Up until the central bank,
yeah.
every state wrote its own script.
Yep. And I mean, I just made the joke to somebody in 1894 when the Pullman guys went on. I mean, Pullman paid them in Pullman paper. They lived in Pullman housing and they shopped in Pullman stores. I mean, it was basically like its own little,
Country, yes.
country in the middle. So
Alex?
it's weird.
Yeah, it's hard for me to know. Gary Gensler was a brick wall for anything to have this conversation, and now this administration has taken a different tact. So we'll see what happens with David Sachs kind of heading up the whole crypto discussion. I'm interested in like the outputs of that. I don't have any good ways to be the weatherman on it. But it's definitely an interesting time to be alive. Yes, reshoring creates more inflation. My basic bet on that is like robotics is going to make up for it and be deflationary, and we'll have plenty of ways to support middle America with manufacturing and robots that take the cogs out of it. I think that happens over the next decade or two, and whether it happens in this administration, that's a long shot. But Howard Lutnick says call the president and make a deal. So I do that. I'm not in that game. Just trying to help a few people.
Well, fantastic. Dan, as usual, you did a great job. Thanks, guys.